We characterise the recent reporting season as being solid without being spectacular. So by number of companies, about 65% of companies met or beat expectations that were set by the market. This is in line with long run averages really, but where we saw weakness was in the larger companies within the index. We sort of dragged that down a bit. So the large banks, the Telstras of the world, really failing to meet expectations. And I think for a number of companies it's difficult because we're in a really low growth environment at the moment. What we saw through reporting season was revenue growth of about 3% and earnings growth, or earnings per share growth for the market of about 0.5%. So not a lot of growth at all. Despite this, dividends were a major beneficiary to investors. Dividend growth of about 7.5% for the market. So, you know, companies have been managed to preserve capital and reward shareholders not through earnings growth, but through dividend growth at the moment. We saw some really good results coming out of a key of the domestic cyclical sectors in the market, which surprised us to a degree, but not totally. Sectors that were recipients of the strength in the housing market did really well. Companies that were, you know, directly exposed to that have held up well. Also, with, you know, interest rates being so low and with unemployment in Australia being quite stable, a number of the discretionary retailers have had particularly strong results. So companies like Harvey Norman and JB Hi-Fi, I mean, they're very much driven by the housing sector. You know, the automotive industry, which again, very close to a lot of Australians' hearts, their cars, is again proving very resilient. And again, we're seeing, you know, broadly speaking, the industrial services sector of parts of the Australian market holding up reasonably well. Well, the disappointment really starts with the banks. So the banks are facing pressures despite the consumer holding up quite well. There really is a lackluster business investment environment at the moment, you know, coming off the back of the resources boom and also a general malaise in corporate Australia to find some growth. So the low level of interest rates at the moment is really hurting their margins. So we're seeing, you know, a bit of disappointment there. Telstra, as expected, again, another big company, really doesn't have any growth at the moment. Outside of that, there have been some sectors of the market that have been recipients of unfavourable regulatory decisions, like the aged care sector, where we actually have some exposure in the portfolio. And then we're seeing, you know, the resource companies earnings suffering from the step down in commodity prices that we've seen as China's slowed. There has been a real focus since the global financial crisis on where companies are allocating capital, how much they're spending. If there's not a good argument for a return that can be justified, then the option is not to spend the capital. There has been a really strong focus on cost control, which has placed companies in a really good position to generate cash flow despite a low growth environment. And where that's really benefited investors, it provides a margin of safety, but the other thing is it's benefiting investors via the return of capital to investors with a prudent balance sheet gearing ratio. And that is, we're seeing good levels of dividend growth as cash flow generation is sustaining, you know, the current levels of debt in businesses. So we're quite encouraged that corporate Australia is in a good position to handle what is a very low growth environment. The outlook for markets is positive, but lower than what it's been in the past. So what we're seeing is that, you know, with where valuations sit in the market at the moment, and these are really being bid up by the low level of interest rates around the world globally, and investors, you know, rotating out of really low returning cash type instruments into equity market where you can get a higher yield, that's pushed valuations higher. That, you know, the buffer on that, or typically what that means is returns from here will be lower than what they have historically been. But we think the portfolio is really well positioned for the current low growth environment. And that is, we've focused on investing in companies that have a structural reason to grow and not purely benefiting from a cyclical environment. We are sitting on higher levels of cash in the equities portfolio than we have in recent years, and that's more reflective of where we see valuations and our expectation that volatility, given this volatility, will pick up in coming quarters, and we're extremely well positioned to take advantage of any of that.